physical and financial investments. The intuitive distinction between physical and financial investments is clear. Physical investment, that is, buying a machine tool or a loom or a truck or even a whole plant to put it to work. Whereas in a financial investment, it is buying a piece of paper promising some future payment. This distinction is essentially correct, but we shall give it a more formal expression using cash flows, which will make it clearer and more operational. So we consider an agent A, an investor, think of ourselves, who considers making an investment I. And to start with, let us look at A and I separately. In the case A does not make the investment I. That is, we shall look at the future of A and the future of I when they don't marry, if you like. Suppose A alone will have the following future cash flows. I've represented them here with arrows, and I've not specified numbers. And I alone will have these blue following future cash flows. If, after having bought I, that is, purchased for a price that I have not specified yet, A, the cash flow of A are simply the sums of the cash flows alone that we just saw, that the new cash flows of A will be the sum of these and that. Here I have represented them. Then we have, by definition, a financial investment. Whereas, if after having bought I, the new cash flows of A are different from the sum of the cash flows alone, and here I have represented them, they are no longer the sums that we had there. They can be more, they can be less, usually they are more. Then, by definition, we have a physical investment. In other words, an investment which does not interfere with our other activities is a financial investment. Its cash flows just add up to our other ones. We purchase a stream of future cash flows and they will add up to our other ones. Whereas a physical investment affects our other activities. Somehow we buy something that will enable us to produce even more cash flows than those that we are acquiring. You could say that, although this is of course caricatural, you could say that in a physical investment, 2 plus 2 is different from 4. It's more than 4. Example 1. Agent A, think of us, buys from an agent B a promise to receive the following future cash flows. In 1 year, A will receive from B 80, think of millions of euros for instance, or just euros, and in 2 years, A will also receive 80. This is a financial investment, and I have not specified the price that A will pay to B today. Let's look a little further at this example. The two future cash flows, 80 and 80, they have a present value that can be computed. It depends upon various factors that we shall study in this course. But think, for instance, that the present value of the first future cash flow of 80 is 60 today. That is, this 80, this promise of 80 in 1 year is worth today 60. And the promise of 80 in 2 years is worth today 50. Well then, the normal price for this promise of two future cash flows today is 60 plus 50, that is 110. And as a consequence, in this example, as in any financial investment, we buy just some future cash flows. They have a value today, and if the seller is reasonable, it is the price we shall have to pay. That's what we just saw here. The sum of the values today of these future cash flows, that is what any reasonable seller will ask for these, just because it's their value today. So NPV in a financial investment is equal to 0. We shall see that there is much more to say about that. But remember that in financial investments, NPVs are 0. In a physical investment, the story is quite different. Let us look at a famous example, one of the most beautiful examples of physical investment, the purchase of Skype by eBay in the fall of 2005. In the fall of 2005, Skype was 3 years old. Its turnover at the time was about an order of magnitude of $10 million, and it had only made losses. And its future cash flows, as a standalone, were small, almost negligible, compared to the huge size of eBay. Yet, eBay paid $2.6 billion for the acquisition of Skype. How did eBay proceed? Well, that's very simple. eBay compared its own future cash flows without Skype and with Skype. Of course, this is forecasting. This was forecasting. Without Skype, it had a stream of future cash flow that it had computed using, by the way, cost accounting and various techniques of planning and forecasting. And he did the same thing with Skype. And suppose I don't have the numbers that Meg Whitman at the time used, of course, but we can make up somehow the reasoning of eBay at the time. Suppose it found that the first year after the acquisition of Skype, it would produce an extra cash flow of $500 million. The second year, this acquisition would produce an extra cash flow of $1,000 million, and then for another 8 years, it would produce an extra $2,000 million. And eBay computed with its own recipes the present values of all these extra cash flows. Here they are. So these are the years. This is the fall of 2005, fall 2006, fall 2007, 8, etc., up to 2015. Well, suppose that eBay forecasts these cash flows I just explained, and also calculated that their present value, taking into account various things, including the risk, by the way, that the present values of these 10 cash flows would be these numbers, 357, 510, 700, etc., up to the one 10 years later, 69. These present values, they add up to $3,246 million. Then the value of Skype for eBay was up to this figure, that is $3.246 billion. As a standalone, as I said, Skype was not worth very much. Its future cash flows, with no operation with any big firm, were small. But Skype's founders, and that were also the owners at the time, knew the value of their firm for eBay. They had figured out numbers of the same nature as this. They didn't have the managerial accounting of eBay, but it was not too hard to make some significant and meaningful forecast of what would be the extra cash flows for eBay of Skype. So the purchase negotiation in the fall of 2005 or before began with a price range between 0, roughly the value of Skype as a standalone, and $3.2 billion. And Skype negotiators were smart enough to finally reach a price of $2.6 billion. and the NPV of eBay, of Skype for eBay, that is of this investment, was therefore 3.2 minus 2.6, that is $0.6 billion. That is, in other words, by acquiring Skype, eBay was creating right away this value. The purchase made sense for eBay. View it like this. Skype was something small, but it was something that would open somehow the creation of much riches for eBay. View Skype as a key to a treasure trunk. The fact that Skype is worth, here in this example, $3, that's the manufacturing cost of this key, doesn't matter. What matters is that it opens a treasure trunk with 3 billion inside. That's essentially the way to analyze the purchase of Skype by eBay. Some more remarks might be made. With $2.6 billion, you can always reproduce the technology of Skype at the time. But by purchasing Skype right away in the fall of 2005, eBay was not so much purchasing the technology, it was purchasing time, because once again the technology it could have produced, but it would have taken several years. And with money you can buy something, but you can rarely compress the time development.